Markets allowed for some relative calm through the end of last week. They are set up now for a pretty heavy macro week ahead. In the midst of a shifting trade narrative and the ramifications of increasing global liquidity, can the equity markets quietly climb the wall of worry here? Has the peak of uncertainty passed? Joining us to discuss his global macro view on equities, bonds, and the players driving a more mercantilist world is Fidelity Head of Global Macro, Jurrien Timmer. Welcome, Jurrien. Great to see you. How are you?
Good morning, Pamela. Great to see you.
Delighted to have some time to speak with you here. So we said, a little bit of relative calm last week. Markets catching their breath. How would you term that?
Yeah, I mean, it's funny, but the markets have basically tuned out the headlines from the president after learning a month or two ago that, they were following the headlines all the way to down 21%. And then the president essentially got the call from Scott Bessent and walked back some of the tariff talk. I mean, they haven't gone away, but they're on a 90-day reprieve, of course. And the markets then came roaring back, rising, rallying 23% after falling 21%. I think the markets are either being overly complacent or very smart, saying, what we hear one day might be taken back the next day, and so why worry about it? And so that's where we are. And I guess as we get closer to that 90 days, maybe things will stir up again. But in the meantime, the three major drivers for stocks are obviously earnings, interest rates, and the risk premium or valuation. And the earnings side has somewhat stabilized here. We go to slide 7. We can see that earnings estimates, did have come down as analysts price in tariffs and what that would mean for the economy. But they're starting to steady out. Actually, if we go to slide 6 for a moment, if you look at the quarterly earnings, the dollar earnings estimates, you have to really squint at this. But if you look at the upper right-hand side of the chart, you can see that some of the estimates for the coming quarters are actually starting to tick up again. So I think that's the market basically saying the market's never priced the worst case scenario. They never priced that extreme left tail. But whatever they did price, they're sort of starting to walk back from a little bit. And so I think that's also part of this calm that we're seeing in the market is that, okay, the markets can handle 10% tariffs. They're okay with that. Worse than that, they can't. But right now, 10% is what we have, and that's what we're going with. And you can see the calm return. My sense is still that other elephant in the room, interest rates, are going to matter. The 10-year yield right now is at 4.46, above 4.5. Kind of the market starts to get a little bit on edge, and so I think that's still something that we need to deal with.
Right, fascinating. You mentioned the earnings estimates, and as you say, they've kind of come down. Does it meet at the right place the sentiment story? We've been talking about this for some time. We're actually about to get a whole bunch of hard data coming up this week, so we'll ask you about that. But the sentiment picture, we mentioned that in the intro, the sort of wall of worry. There's worry, bad sentiment, and so on, and yet.
Yeah. So we go to slide 8. So I think I always have to ask myself, like, okay, so I'm in the camp now that markets are stuck in a range and that we're kind of on the high side of the range, the upper boundary, and that upper boundary is limited by what happens to bond yields if they rise. So to me, that's going to contain the rallies from here. But on the other side, if we go back down again, not that we will, but if we do, I think that kind of that fiscal put starts to come back in. And so I think that's where we are. But I have to always ask, how could I be wrong, especially given that the markets are kind of chill here, right? So I just showed the chart before, and you can see that on the sentiment side. So this is the Investors Intelligence Survey, and you can see that we had more bears than bulls a month or so ago. And that's the same backdrop that we had in 2022. So pretty bullish backdrop when most investors are very cautious. And even though the markets have almost recovered all of the decline, the sentiment remains somewhat cautious. So it shows you, again, that wall of worry that you mentioned, and that investors are not believing everything they see, and also they just finished selling. So that's actually a good backdrop that this wall of worry can continue to be climbed. And at the same time, if we go to the next slide, so the first slide was regular investors. This slide shows what corporate insiders are doing, and corporate insiders were buying the lows, and that's a very good sign because that's supposedly the smart money. And so the narrative here is that maybe I'm too bearish by being neutral. Maybe neutral is not bullish enough. And if we look at slide 3, for instance, and we just look at the current cycle compared to previous. So this chart shows what happens when the market has fallen 20%. And you can see it continues to fall the best case scenario, which was the fall of 2018, that massive reversal that we saw after we got the Powell pivot, right? We haven't gotten the Powell pivot this time, but we've gotten a Trump pivot in some ways. Right. And so what am I missing here by not being more bullish? And if we look at the next slide, which is credit spreads on the same basis as the previous slide, you can see that after investment grade spreads widened 60 basis points, back in March and April, they've recovered not all of it, but a lot of it. And so if credit analysts are, the smarty pants in the room, and they're not seeing any trouble on the economic horizon, then again, maybe the glass is more half full than half empty. So I need to be cognizant of that. But the main thing that gives me pause is really slide 11, and that's the bond side. I know you're going to ask me about that, but to me, that sets the upper boundary here for the markets, because the 10-year yield has been in a range now of 3.75% to 5% for several years. And right now, the term premium is rising, as it should, because we have a fiscal train that is, that can't be stopped, and we don't have a Fed or other central banks that are out there mopping up the excess supply. And so the term premium is rising. It hasn't made the bond market break out yet because inflation expectations remain very contained, and we actually got a pretty constructive print from the PCE last week at 2.5%. If that were to change, we would be at 5% pretty quickly, and the stock market is not going to like that. So that's what's keeping me from being more constructive here.
So, and let's talk more about why that matters to the stock market and sort of the competition element to it. But first of all, last week, I think at the end of the conversation, you were taking us through M2 and the money supply. There's money sloshing around out there, which is tricky because, as you say, it needs to be mopped up somehow, or it needs higher rates to make it not be super inflationary. Just take us back there a little bit. What it sort of means for the rate story, that the money supply, there's ample liquidity, basically.
Yeah. So slide 10. So this is the MSCI All Country World Index, which is at the old highs now. So it's outperforming the S&P, which is below the highs. And actually the ex-US chart is at new all-time highs for the first time since 2007. I'll show you that chart later.
That's amazing.
But the red line is the global money supply. It's now growing at an 8% rate of change. It's at an all-time high. And markets, the stock market, likes liquidity because more liquidity means more dollars or loonies or yen sloshing around looking for a home. And so liquidity tends to drive up valuations. But at the same time, the bond market doesn't always like it because more liquidity or more money supply typically means more inflation or more fiscal growth or fiscal dominance, as I call this regime that we're in. And that means that without the Fed cleaning up the mess, basically, you have upward pressure on rates. And we can go to slide 12 here. And why does it matter? Well, when yields were 1% back in 2020, remember that 1% yields.
It seems like a long time ago now, actually.
If they went from 1 to 2, it would have some effect on valuations for equities because you have the convexity and you have the discount rate and the discounted cash flow model and all that good stuff. But it doesn't make bonds much more competitive to stocks at 2% or at 1% when the stock market is yielding 5%, right? Or the PE is at 20, inverse is the yield. So it's not really that competitive. And you can see, so this chart shows the Fed model, which basically compares the bond PE, so the inverse of the yield, to the equity PE. And the part in red is the period in history when bonds and stocks were correlated, as they are now. And when that happened and bond yields were competitive with equity yields, when those yields would go up and the correlation is positive, the stock market needs to adjust its valuation to remain competitive with bonds. So that's the Fed model. It was Alan Greenspan's supposedly his favorite indicator back in the 80s. The Fed model sort of captured the math behind the 87 crash. The Fed model did not work in the last couple of decades because the Fed and other central banks were repressing interest rates and pushing the risk premium in bonds down. And so the relationship broke apart. But now I think it's back on. And if we go back to 2022, the bond market basically has been in charge this whole time. And that's potentially a paradigm shift that we're going to be living with for a number of years to come.
I wonder if you can put that in context for us, because as you say, it was repressive at the time. And I think you used to use an analogy of like a beach ball being held underwater, which can be done for a period of time, but ultimately it will normalize. What sort of normalization period are we in? Because it seems that bond yields normally, historically, could be quite comfortable at 5%. I mean, I know we're sort of concerned about it hitting that, but it's not that weird if you go back further into history.
Yes. So we can pull slide 11 back up. It only shows a limited amount of history, but again, the bottom panel shows the term premium. So the term premium is the risk premium for long-term bonds, whether they're corporate bonds or governments or what have you. And it's what investors want to get paid to lend money for long durations, like 10, 20, 30 years. And so it's the additional compensation an investor wants for lending long versus lending short. And so for corporates, that could be a credit risk. For governments, it would be inflation or a fiscal shenanigans or what have you. And normally that term premium is positive, as any risk premium ought to be, right? I mean, otherwise it wouldn't be a risk premium, it'd be a risk discount, basically. And this chart shows that QE era, right? That era of zero rates and quantitative easing pushed the term premium to below zero. And that's all due to central banks' heavy hands. But if you go back beyond that to the 70s, 80s, 90s, 60s, 50s, the term premium was generally positive on the order of a couple of hundred basis points. And so we're reverting back to that trend. You can see we're at 84 basis points now and rising. And that's exactly what should be happening when the Fed is not mopping up the supply and this fiscal train, has left the station and is not going back anytime soon. Even Elon is no longer in Washington, doing the whole Doge thing. I mean, that was, we kind of all could have seen that nothing stops this train, and I think he's getting the memo as well. So if we were to go back to 150 basis points on a term premium, which I think is plausible over the coming years, you're looking at a 5 handle on the 10-year. And that's, again, it's not the end of the world. It's where bonds generally are. I mean, you've got a term premium, you've got a real yield, which essentially is what the term premium measures, and then you've got an inflation spread. And so for the bond market, this is fairly normal. And for bond investors, this is not a bad situation because, at 4.5%, investors are getting 1.5% over the inflation rate. So there's nothing wrong with that. And even if yields go above 5, you're still reinvesting your coupons at higher yields. So that actually is not bad from a total return perspective. But where it matters is that, again, that Fed model, those rising yields above 5 are very competitive with equities who are trading at a 21 multiple, which is a below 5 earnings yield. Yeah. And so that's, I think, where the risk is. And again, it doesn't mean the stock market has to go down. It just means that valuations are not going to be amplifying earnings growth like they have been over the past couple of years. Instead, they could be offsetting earnings growth. And then you have to figure out, okay, if the PE goes down by a few points and earnings go up by, let's say, 7%, which is the current expectation, that still brings the market down, but not by a lot. And so I think it's that dance, that interplay of valuation and earnings, where the valuation side is pushed lower by rising yields, and then it's a question of how much they offset each other.
And so, talking a little bit about where the Fed model could come in potentially, and the idea of fiscal dominance, which you've been talking about. Why do we keep hearing about bond vigilantes?
So the bond vigilantes are, this is an old term. I forget who coined it. I think it was Ed Yardeni, maybe, who's a great strategist, by the way. But yeah, so the bond vigilantes are the ones who say, well, I'm not buying this debt at these yields when the fiscal story looks this bad. And so those vigilantes, throw cold water on any party that might be happening on the asset side. And so, again, that basically is the Fed model, right? So the bond market is reacting to growth, inflation, the fiscal story. And if the yields go higher because bond investors go on strike, which they can do when the Fed is buying, and no one will even know the difference because the Fed is buying trillions of dollars of bonds. But if the Fed is not buying and the bond vigilantes go on strike, and also the Bank of Japan is not buying, the Bank of China maybe is even selling, that difference is going to be felt. And when your debt service is running well over $1 trillion a year now, and your funding costs are 5 instead of 4, that makes a difference. And so the bond vigilantes are very powerful. And we don't have the situation anymore like we did a few years ago in October of 2023 when the yield went to 5%. And Janet Yellen, who was at the Treasury, of course, was able to just change up the maturities profile of what was going to be issued. So she went from issuing long bonds to issuing T-bills, knowing that there was a $2 trillion pile of reverse repos sitting at the Fed that money markets would invest in, and that they could just easily substitute out to buy Treasury bills. So that was a really brilliant move and very really low-hanging fruit to just, fix the problems with the bond vigilantes while knowing you have buyers for T-bills. We can't do that again. Like Scott Bessent cannot do that because there are no repos left. There's maybe 100 billion or so, but not enough.
Is there a third
Scott Bessent
way?
doesn't have the option.
Yeah, okay.
He doesn't have the option of changing maturities because it still has to be new money that's going to be invested. And so this kind of fiscal cliff, if you will, of bond vigilantes not taking any more, I think is going to be more prevalent now. And again, Doge has come and gone. We see the big beautiful bill in Congress right now. That's going to add several trillion to the deficit. Maybe some of it is offset by tariff income because the tariff income is rising, but probably not enough. And so I think this is a story that we're going to be talking about for a long time because those deficits are not going away.
The deficits aren't going away. And in the midst of sort of the tariff discussion and I guess the revenue that provides ultimately to the government coffers, there is this shift. We know about the trade narrative globally shifting and changing. Part of it has to do with internal dynamics of a budget for countries, but part of it is, it seems like a hard switch. You mentioned, I think, from globalism to mercantilism, which goes back in history a long way.
Well, and the risk is, so let's go pick up slide 17 here, which is the dollar. Even as the president walks back on some of the more scary tariff pronunciations, you wonder if the damage is being done nevertheless, right? So this notion of U.S. supremacy or U.S. exceptionalism, the U.S. has enjoyed what I call a supremacy premium now for many years, where it trades at a valuation above other countries, mostly justified because we have big dynamic growth companies that buy back shares and have higher payout ratios. We have very high profit margins. So I'm not saying that that's like a bubble or anything like that. It's justified. But a lot of that also has come from trillions, tens of trillions of foreign capital coming into our markets, either as foreign direct investment or investment into our public equities, our public bond markets. And so if this notion of the zeitgeist moving from a globalization, to a more mercantilist environment where we're just going to do what's right for us, meaning the U.S., not me, and we're going to send fewer dollars overseas. If those fewer dollars then become fewer dollars coming back into our markets, or foreign capital decides to go elsewhere, then you have an impact on our capital flows, which of course would be seen in the dollar. And so I don't know to what degree that's going to happen. Certainly some of the more aggressive reciprocal tariffs are being walked back. Maybe there'll be some big, beautiful deals coming out in the coming few months. But it is a risk that we go from that supremacy premium and we give it up and we get to a more level playing field, which isn't necessarily a bad thing. Right. But it brings into mind this difference between the U.S. and ex-U.S. And with that in mind, let me just go to slide 14. Please. And it is a pretty big contrast right now, right? So this is the U.S. S&P 500. That's a beautiful chart, right? All the trend lines are rising, and we're either moderately above it, or
what's the yellow?
What's that?
What's the yellow?
So the yellow is the trend line for this secular bull, the way I define it at least. So since 2009, and the pink is a longer term trend line, and you can see that the yellow one has a steeper slope than the pink one, and that's because it only measures the secular bull market. So on that trend line, we're right on that trend line. The pink one, we're slightly above it, but not in a huge way. But so this has been obviously the big success story of the last couple of decades. And meanwhile, if we go to slide 15, we show the rest of the world, this is the MSCI All Country World ex-US. Not as beautiful. It is finally making a new all-time high for the first time since 2007. I mean, that's how long the rest of the world has been just lying around doing nothing. So the big juicy opportunity is like maybe this is when the big mean reversion happens. And if you look at the bottom panel there, the blue line is momentum measured in absolute terms, and the orange line is momentum measured relative to the S&P 500. And you can see that there is a convergence between those two, which tells me that the beta story around the world may be becoming more modest, but the alpha story or the alpha opportunity is becoming more pronounced. And that would be mean reversion between U.S. and non-U.S. assets. So that, I think, is a big theme that we've been thinking about for a long time here in the asset allocation group, but something that certainly is going to continue to play out, I think.
Yeah, fascinating. It's been such an interesting year for this and to where it goes from here. I'm grateful for your thoughts, Sarah. Here are a couple of great questions. I'll put these to you. What are your thoughts, Jurrien, on Trump's tax bill, namely taxing foreign dividends and treasuries?
Yes, it's a great question, and that is, it's you can see that the White House is trying to punish anyone not playing along, right? And so it's on the tariff side directly, of course. You're a friend, we'll make a deal. You're not a friend, we're going to charge you. And this is sort of an indirect way of doing the same thing. So countries that are investing in the U.S. or investors that are foreign investors investing in the U.S. who are deemed to be in an unfriendly regime, if you will, are going to get punished by having withholding taxes charged on their assets. And again, I don't know how much teeth it will have, how much impact it will have, but it's yet another little nail in the coffin of what we just talked about this supremacy premium, right? If this is going to be all these little things that are going to add up, maybe investors are just going to say, you know what, Germany looks pretty good right now. I'll just buy German stocks because they're doing a fiscal thing. And so it feeds into the narrative that this might be a slow drip kind of where that supremacy premium whittles away as money. Maybe it doesn't even leave, but it certainly, or it may not move in. There may not be more capital flows on top of the old ones.
That's really interesting. Yeah, it fits actually perfectly with what you were just describing. Another question, thoughts on how markets may react if U.S. debt reduction begins to be more of a priority? Yeah, I mean, if they do make cuts to so-called entitlements, I don't know. What do you think?
It's not going to happen. No. Very little of the budget is discretionary. Most of it is entitlement spending, Social Security, Medicare, Medicaid, and then it's defense, and then it's debt service. And I don't think anyone is going to touch any of them. And even and what is touchable is very little. And even then, I think Elon was only able to find 175 billion of cuts, and that's on a budget of 7 trillion. Right? It's not nothing. I mean, it's good that it happened, but so it's not, nothing is going to stop this train, basically. And even Scott Bessent recently kind of admitted or that much and said, look, we can't really, I'm paraphrasing, we can't really reduce the debt or the deficit, but we can try to outgrow it, right? And that's a fair point. If you can outgrow your debt is sustainable, right? I mean, think of it, if anyone borrows money to start a business, and the business grows faster than whatever you're paying on debt, then it's money well spent, right? Because you're using leverage in the right way. Of course, that hasn't happened in this country because we have aging demographics. The labor force is not growing that much, but maybe a productivity boom from AI will do it. Who knows? And the easy metric to follow is nominal GDP growth needs to be higher than your benchmark bond yield. So if the 10-year Treasury is at 4.5 and nominal GDP growth is at 5, it's not a huge spread, but at least at that point your debt is considered sustainable. But if the debt rate goes above the growth rate, then you're in trouble. But so far that isn't the case. So that's really the only answer, is to either grow out of it or devalue or inflate your way out, or a combination of all of the above.
Yeah, and I mean the dollar is devaluing, so there is a piece there. Yeah. Just with sort of a minute left, and it's not enough time, but a discussion on the 60-40 based on what you're saying about bonds, where equities might be range bound, might not be. Is it still the same old 60-40? I mean, are they both going to do what they're meant to do?
Yeah, so we'll go to slide 21. I'll make it quick. So for me, the 60-40 days are over, and we've talked about this, and I think of it more as like a 60-20-20. So on the left is the 60-40 of yesteryear. It's all you needed. Those two assets, S&P 500, Bloomberg Ag, and you were done. You got 9% a year with 9% vol, and that was a pretty good outcome. I think the 60 is still the anchor. Maybe it's less U.S. and more international. But the 40 is where I would make change. And this is not investment advice, but it's just my own personal view. If bonds were meant to be protection against accidents, right? So the stocks were driving the bus. Bonds kept you out of trouble. I think we're in an era now where bonds are causing the trouble, not getting us out of trouble. And so that tells me I want to have fewer bonds. I don't want to have zero bonds. I want to have some bonds because you're getting a real yield. It is an income-driven bucket. But then you want assets that are sort of uncorrelated, not just to the 60, but to the 40. And I think that's the important thing. And if we go to slide 20, I'll show you, because we're used to thinking about the 40 as insurance against the 60. But what if it's the 40 that's the problem? And that problem in the 40 could cause problems in the 60 per the Fed model. Sure. We want assets that are neither correlated to the 60 nor the 40. And those do exist. So if you look at this chart, the blue bars on the left, the ones in blue are showing high Sharpe ratios that also have very limited or no correlation to either stocks or bonds. And those are cash, absolute return strategies, market neutral kind of hedged equity types of strategies, and gold and Bitcoin. Yeah. Those buckets have neither a correlation to either the 60 or the 40 while having very high Sharpe ratios. And to me, that's where that last 20 of the 60-20-20 goes.
Fantastic. Everyone's going to see you in Vancouver soon. You're traveling to Vancouver to speak to lots of people of Fidelity. So we wish you safe travels and lots of great meetups there.
Great. Thank you very much.
See you next week.
See you next week.